Welcome to Illuminati Silver. We tell you the truth about silver. Today is Thursday the 18th of June 2020, and yesterday we produced a video entitled Equities Still Rising While Gold and Silver Consolidates. And on Tuesday, US economy shows some signs of recovery, but is it only temporary? Where we highlighted the recent economic figures, started with last week's jobs reports, and now this week's positive retail sales figures of plus 17.7% for May and a positive industrial production figure for May of 1.4% is showing at least tentatively that perhaps the US and maybe the global economy at large has to some extent bottomed. Now, yesterday we pointed out we should look out for the weekly job figures announced today in the United States, and they have come in at 1.51 million compared with last week's 1.57 million and expectations of 1.13 million. When I say weekly jobs figures, I mean weekly jobless claims figures. Now, the Philly Fed Manufacturing Index for June was indeed encouraging, coming in at 27.5 compared with minus 43.1 last month and against expectations of minus 20. Also, the leading economic indicators for May came in at a positive 2.8% compared with minus 6.1% in April. So we are witnessing a continuing of relatively positive economic information. Now, Reuters published a brief article earlier today quoting the comments from the Bank of England governor about what is happening in the United Kingdom. So we shall take a brief look at this and then talk a little bit more broadly about how some investment banks are advising their clients to buy gold. But first, let's take a look at this Reuters article. Reuters article dated June 18th. UK economy starting to recover, but jobs news bad, Bank of England's Bailey says. Britain's economy is recovering a bit more quickly than the Bank of England thought a month ago, as the government eases its COVID-19 lockdown. But news from the labour market is mostly negative, Bank of England Governor Andrew Bailey said. As partial lifting of the measures takes place, we see signs of some activity returning. Bailey said after the Bank of England announced a £100 billion increase in the size of its bond buying programme, but slowed the pace of purchases sharply. We do not want to get too carried away by this. Let's be clear, we're still living in very unusual times. Bailey told reporters that the Bank of England's plan to stretch its now £745 billion bond buying programme until around the turn of the year was still faster than anything done by the British Central Bank prior to the coronavirus crisis. We're slowing from warp speed to something that by any historical standards still looks fast, he said. Deputy Governor Ben Broadbent said the Bank of England now estimated that Britain's economy was heading for a roughly 20% contraction over the first and second quarters of 2020, compared with a fall of about 27% included in a scenario it published last month. Broadbent said negative news from Britain's labour market was probably more significant for the inflation outlook, which is central to the Bank of England's mandate, than then pick up in activity. On negative interest rates, Bailey repeated previous comments that they were an option for the Bank of England, but that the issue was complex and taking borrowing costs below zero was not in any way imminent. End of article. Okay, now in spite of this relatively good news, let's have a look at how markets have behaved. They perhaps have not reflected it fully. Now, European markets have broadly closed down by an average of 0.5%. And at the time of producing this podcast, which is before US markets have closed, the Dow is down 130 points at 25,989. The S&P 500 index is down 14 points at 3,099. The Nasdaq is down 1 point at 9,910. The dollar index is still on its strengthening path and is up today 0.26 at 97.42. Now, gold is currently down $4 on the day at $1,724, and silver is down 10 cents at $17.43. And just for interest, the gold to silver ratio stands at 99 to 1. Now, we are concerned as we are now beginning to see certain pumpers re-emerging with $100 silver claims and now up to $15,000 gold. And whilst we are the first to say that these levels of stimulus and money printing will undermine most global currencies, it is still, quite frankly, irresponsible and deceptive in our view to even pretend that we're anywhere near $100 silver, or even anywhere near $50 silver, and for that matter, anywhere near $30 silver. And as for gold, as we've often said, we will be surprised if we even touch 2,000 this year. Now, having said that, and something we have reported on numerous occasions, is that investment advisors are now recommending gold to clients. And some big names have begun to do this too. So let's take a look at another article published by Reuters today, highlighting this very fact, and perhaps to some degree supporting our view on where the gold value lies before this year is out. Reuters article dated June 18th. Headline: World's ultra-wealthy go for gold amid stimulus bonanza. As stock markets roar back from the coronavirus-led rout, advisors to the world's wealthy are urging them to hold more gold, questioning the strength of the rally and the long-term impact of global central banks' cash splurge. Before the COVID-19 pandemic, most private banks recommended their clients hold none, or just a tiny amount of gold. Now some are channeling up to 10% of their clients' portfolios into the yellow metal, as the massive central bank stimulus reduces bond yields, making non-yielding gold more attractive, and raises the risk of inflation that would devalue other assets and currencies. While gold prices have already risen 14% since the start of the year to $1,730 an ounce, many private bankers bet that gold, a hedge for both inflation and deflation, has further to run. Our view is that the weight of monetary supply expansion is going to ultimately be debasing to the dollar, and the Fed commitments which are anchoring real rates make the case for gold pretty sturdy, said Lisa Chalette, Chief Investment Officer of Wealth Management at Morgan Stanley. 9 private banks spoken to by Reuters, which collectively oversee around $6 trillion in assets for the world's ultra-rich, said they had advised clients to increase their allocation to gold. Of them, 4 provided forecasts and all saw prices ending the year higher than they are now. UBS, the world's biggest wealth manager, said gold could hit $1,800 by year-end in its base case scenario, driven by ultra-low interest rates and investors seeking gold to hedge their portfolios, or even touch a record high of 2,000 in the event of a second wave of novel coronavirus infections. With the recent equity rally, people have become more nervous. People are actively seeking out portfolio hedges that might perform well in a range of scenarios, said Kiran Ganesh from UBS's Chief Investment Office. Morgan Stanley added a 5% position to commodities, including gold, in all its models at the end of March. While the bank was unlikely to advise a position above 10% in commodities like gold, Chalette said it could get there, especially if inflation picks up materially. The boost in demand could be a self-fulfilling prophecy for the metal's price, as any shift in allocation from bond and equity markets, estimated at up to a combined $200 trillion, has a much larger impact on the smaller gold market, estimated at less than $5 trillion. Now, while queries about gold have increased, very few clients have demanded a wholesale move into gold, something they would have been advised against, the banker said, adding older clients tended to be more concerned about inflation risks. That cohort is very concerned about wealth preservation, and in many ways they have a longer historic lens than some of our other clients, so they do worry about inflation, Morgan Stanley's Chalette said. John Laforge, head of real asset strategy at Wells Fargo Investment Institute, said from 2 calls a week on gold last year, he's now at 2 calls a day, spiking to 10 calls when the metals had a good day. I'm now getting as many questions on gold as I do on oil, which says a lot from my perspective. Most people are interested in renewables and oil and so on, and gold was often considered a relic, Forge said. Despite the fact that gold pays no income Oliver Gregson, head of the United Kingdom and Ireland at JP Morgan Private Bank, said inquiries had gone up as clients increasingly viewed it as a port in a storm. He forecast a $1,750, that's $1,750 year-end price target. For those looking to hedge their bets with a shift to gold, the choices can be split into four. Gold mining companies, index funds, which represent shares in real gold or track the price of gold, derivatives such as options and futures, and gold itself in the form of bars or coins. For hedging purposes, the first three are fine. If worries run deeper, investors normally opt for the physical. Now, most of the larger banks offer a gold bar storage service, and 8 of those questioned by Reuters said they had seen an uptick in demand, particularly in locations such as Switzerland and Singapore. Andre Portelli, co-head of investments at Barclays Private Bank, said while some clients had begun adding physical gold in early 2020, as COVID-19 spread, the trend had continued. A supply disruption of physical gold in March and April due to the closure of major gold bar manufacturers and lack of international shipping capacity fueled also additional client interest. End of article. So there we have it. Gold is a good buy. That means it's good to buy. But do not expect massive rises in the very short term. As we've said frequently, this decade will be the decade for precious metals, particularly gold and silver. What do you think? Do share your thoughts. Thank you so much for listening. If you haven't already done so, please subscribe to our channel. And do not forget, please, to press the bell sign so you're notified of our videos as and when they're published. Now, we do update our Richard and Greg channel every few days, though this time we have missed quite a few days, and I'm pleased to report that in a couple hours after this video goes live, a discussion with controversially Greg will be published on the Richard and Greg channel. It's an interesting subject, and as always, Greg is extremely controversial and to some extent a little insulting. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.